This is Pakistan, the 23rd largest economy in the world by purchasing power parity, housing 230 million people. Currently, the country is facing a situation of complete economic collapse. Unlike the economic collapses experienced by advanced economies, this collapse has the potential to lead to mass starvation, particularly affecting the world's fifth largest population. These economic issues have garnered the attention of numerous economists due to Pakistan's influence and its reliance on major global economic events. Pakistan plays a crucial role in China's Belt and Road Initiative, serving as both a trading route and a source of supplementary labor for the world's second-largest economy. Moreover, Pakistan boasts one of the largest foreign workforces globally, with approximately 10% of the country's GDP being sent back home by its workers employed abroad. These workers predominantly find employment in countries like Saudi Arabia, the UAE, and the cooperative Gulf states, which have been the subject of controversy regarding the global politics and treatment of migrant workers. Understanding the economic dynamics of this labor force can provide valuable insights into the future. Additionally, Pakistani workers send billions of dollars back home each year from countries such as the UK, USA, Australia, and the EU. Therefore, the fate of Pakistan's economy holds significant ramifications for our own economies and workforces. Notably, Pakistan's economy is often viewed through the lens of its hostile relationship with India, a major economic power in the region. India shares many industries with Pakistan, further complicating the economic collapse and drawing comparisons to Sri Lanka's recent economic crisis. While there are similarities between the two, it is important to highlight the differences. Pakistan possesses a larger economy, greater regional influence, and serves as the world's sixth largest nuclear power. It is crucial to approach the situation with caution, as pushing a nation armed with a substantial arsenal of devastating weapons into a desperate situation is far from ideal. Now, let's explore how Pakistan fell into this economic crisis, its impact on the neighboring economic region, and the steps being taken to revive the struggling economy. In emerging market debt scenarios, it is often assumed that low-income or developing economies are bound to experience economic catastrophes repeatedly. This assumption holds some logic, considering that nations less established in the global economy find it challenging to borrow money from reputable institutions at reasonable interest rates, unlike advanced economies. Advanced economies often have the advantage of borrowing money in their own currency, granting them greater control over their debt burdens. For example, Japan can sustain a government debt level that reaches 260% of its total national GDP because it borrows money in yen, a stable and widely recognized global currency. Japan also benefits from low or even negative interest rates on its borrowed funds. Moreover, Japan can rely on borrowing money from its wealthy citizens and possesses trillions of dollars in other currency reserves, such as US dollars. This assurance provides investors with confidence that the loans will always be repaid, regardless of the debt level. In contrast, Pakistan faces challenges in borrowing money in its own currency since its population does not possess the necessary wealth to meet the government's borrowing requirements. International institutions are reluctant to provide loans denominated in Pakistani rupees due to significant foreign exchange rate risks associated with a currency rarely used outside of Pakistan. Consequently, Pakistan has resorted to borrowing in foreign currencies, predominantly the US dollar and increasingly the Chinese RMB. These loans typically demand higher interest rates or entail political conditions because the lending countries or institutions assume significant risks that repayment may not occur. Having higher interest rates in a currency that the country has no control over exposes it to various risks. These risks include devaluation of its own currency, decreased demand for exports, and the possibility of growth rates not surpassing the interest rates charged. Advanced nations, with good economic management, political stability, and lower levels of institutional corruption, are better equipped to avoid economic crises experienced by developing economies. However, advanced economies are not immune to making poor decisions, as seen in the UK over the past 6 months. The difference lies in their ability to withstand mistakes before the entire economic system collapses. This is largely due to their secure and affordable borrowing options from a wide range of investors. Advanced economies also provide greater individual security, as the average citizen in a developed country is less vulnerable during economic downturns. While people may lose their jobs and experience a decline in their quality of life, they will not face starvation or resort to desperate measures to meet basic needs. Additionally, advanced economies benefit from highly value-added exports, which they can offer to the global economy. For example, if South Korea faced an extended recession, the devaluation of its currency would make its exports more competitive. This would lead to increased sales of products like smartphones, container ships, and tourist holidays to international buyers. This self-corrective mechanism helps alleviate negative economic pressures and provides a consistent source of foreign income to repay debts. In contrast, Pakistan faces challenges due to the devaluation of its currency. The country heavily relies on imports to sustain its basic industries, which predominantly produce commodities like rice and linens. Unlike specialized goods that are sourced from specific countries, these commodities compete in a global marketplace. A struggling economy cannot produce them as efficiently as industrial agricultural centers with stable infrastructure and financing. Tourism in Pakistan is improving, but most visitors come from the Pakistani diaspora visiting friends and family. High-spending tourists from Western countries are reluctant to visit Pakistan due to safety concerns and a lack of attractions that attract adventurous travelers to other countries in the region. These factors contribute to Pakistan's vulnerability to economic challenges, including the current economic crisis. It is worth noting that despite these vulnerabilities, Pakistan was previously recognized for its surprising economic resilience. The Asian financial crisis in 1998 affected many rapidly growing economies in the region. The crisis began in Thailand, where the government was compelled to float the Thai baht due to a shortage of foreign currency. Floating exchange rates are determined by market demand, while fixed or pegged currencies maintain a specific conversion rate. Despite the country's vulnerabilities, Pakistan's reputation as a resilient economy should be acknowledged. If investors wish to withdraw their profits from the factory after a few years, the government will convert the Thai baht back to American dollars. This system is highly favored by international investors because it eliminates the foreign exchange rate risk associated with investing in foreign currencies. It is not beneficial if an investment doubles in value while the currency it is denominated in depreciates by half during the same period. A fixed exchange rate ensures that this situation does not occur. Additionally, a fixed exchange rate facilitates easier and often more competitive global export for local industries. When the government sets the currency price 10% lower than its free market trading value, goods exported from that economy effectively come with a 10% discount for international buyers. Who wouldn't appreciate a discount? Even if the government fairly pegs its currency, the stability of knowing the cost of goods from a regular supplier without worrying about daily exchange rate fluctuations is a compelling reason to engage in business with an economy that has a fixed exchange rate. In the late 1990s and early 2000s, fixed exchange rates were particularly popular among Asian economies heavily reliant on industrial exports and international investment. However, maintaining fixed exchange rates is expensive. The government must always have enough foreign currency reserves to honor any transfer requests. While exporting a significant amount and receiving a constant flow of foreign dollars into the economy can sustain this, a bad season or an economic shock could deplete the supply of foreign currency. Once an individual attempts to exchange their currency for US dollars at the agreed-upon rate and fails, the entire system collapses. Other investors will follow suit, leading to a national-level bank run. This is precisely what occurred in Thailand in 1997, causing shockwaves throughout the region as other growing economies like South Korea, Indonesia, Taiwan, and the Philippines, which operated similar systems, faced similar concerns. The worry was that if the Thai government ran out of funds to maintain their currency peg, these other economies might experience the same fate. As investors withdrew their money, it became a self-fulfilling prophecy. Eventually, almost all the countries involved had to abandon their pegged currencies and allow them to float freely. Although they lost the advantages that came with a pegged currency, their economies suffered as a result. Remarkably, Pakistan remained mostly unaffected during this period of turmoil, demonstrating its remarkable resilience. During the same period, Pakistan faced challenges with the international community due to openly testing nuclear weapons. The country faced heavy sanctions similar to those currently imposed on Russia. These sanctions were further intensified after the September 11 attacks when Pakistan was implicated in supplying fuel and weaponry to the involved groups. Additionally, the country had to manage an influx of refugees from neighboring war-affected countries like Afghanistan. As if the global economic environment wasn't hostile enough, Pakistan also endured the worst droughts in its history, lasting 4 years and severely impacting food production. Despite these numerous challenges, Pakistan's economy displayed incredible resilience and even sustained growth during this turbulent period. While the economy was not initially large or sophisticated, it did not experience as significant a fall as many of its neighboring countries. Surviving this perfect storm of economic shocks relatively unscathed speaks volumes about the nation's self-sufficiency. If it managed to survive back then despite numerous challenges, why is Pakistan facing difficulties today? The primary reason for Pakistan's struggle today is the relaxation of sanctions in the Southeast Asian economic region, which led to a rebound in their economy. Since then, the Pakistani economy has grown significantly and is now nearly 4 times larger than it was in 2000. Consequently, the potential fall is greater, and it is highly unlikely that the economy will ever shrink back to its previous level. Therefore, even the worst possible economic scenario today would still be better than the best possible conditions back then. The current crisis can be traced back to the impact of COVID-19. With the pandemic, the economy faced a major disruption as a crucial source of foreign currency revenue, remittances from Pakistani workers abroad, was cut off. These workers would typically send money back home in globally recognized currencies like US dollars, which their families would exchange for Pakistani rupees to meet their daily needs. The government and exchange institutions would collect those rupees in exchange for American dollars, creating foreign currency reserves. These reserves were utilized by the government and large businesses to purchase imports that the economy had become dependent on, such as petroleum, fertilizer, and machinery. However, without the inflow of remittances, the nation lost its ability to pay for these essential goods, as Pakistani rupees are not accepted outside of Pakistan. The disruption of foreign remittances was just the first problem. The second problem arose from the escalating costs of the same imported goods. The conflict in Ukraine increased the prices of oil and agricultural supplies, resulting in reduced income and increased expenditure for Pakistan. Additionally, the country faced devastating floods that claimed the lives of over 1,700 people and caused economic damages worth $30 billion. These challenges evolved into crises as the government attempted to control living costs for financially vulnerable citizens by imposing caps on electricity and gas prices. This measure placed a significant burden on the government and businesses and led to fuel shortages, rolling blackouts in certain regions, and a decline in energy consumption. In an effort to curb the outflow of foreign currency, the government implemented import restrictions, particularly on non-essential goods. However, most of these efforts only accelerated the rush of people trying to exchange their rupees for more globally recognized currencies before it was too late. Furthermore, the government imposed additional limitations on cash transfers by individuals, resulting in the existence of 3 exchange rates in the country. These rates include the rate recognized by the central bank, the rate at which private institutions complying with government regulations exchange money, and the black market rate determined solely by supply and demand. All 3 rates are declining, but it is needless to say that the government rate is significantly more optimistic than the actual black market rate. The situation may seem absurd, but it is important to consider that the average Pakistani lives on a meager $15 per day. Therefore, they are highly vulnerable to a situation where the country lacks the means to import basic essentials. So, how can this situation be resolved? International institutions have proposed solutions to provide support in the form of loans, offering the necessary cash to replenish Pakistan's reserves and recover its economy. However, these offers come with conditions. The International Monetary Fund, IMF, an institution funded by multiple global economies with the goal of supporting countries experiencing economic turbulence and preventing its spread, seems to be the obvious answer. The IMF has already granted Pakistan billions of dollars in loans and has promised billions more, contingent upon certain changes made by the government. One significant change is to allow the country's currency to freely float in the foreign exchange markets. The government has been hesitant to implement this measure, as there are advantages to having a pegged or controlled currency, especially for a country like Pakistan that has experienced significant growth over the past 2 decades, despite its challenges. China has also emerged as a major lender to Pakistan, providing loans totaling $30 billion, approximately 3 times the amount given by the IMF. These loans are part of China's Belt and Road Initiative, which includes Pakistan as a strategic stopover for rail and shipping routes to Europe and the Middle East, essential trading partners for China. There is a modified saying that applies here: if you owe the Chinese government $1 million and can't pay it back, you have a problem. But if you owe the Chinese government $30 billion and can't pay it back, they have a problem. China might extend assistance to avoid an economic collapse, as it would result in significant debt write-offs and reflect poorly on the progress of the Belt and Road Initiative. However, this assistance would come with its own conditions, including aligning with China's geopolitical ambitions and prioritizing their access to Pakistan's natural resources. If Pakistan manages to secure funding to sustain its economy, despite the decline in confidence caused by alarming headlines, there is potential for resuming exports, ensuring vital imports, rebuilding trust in the country's currency, and reigniting growth to pre-crisis levels. Don't let important updates pass you by. Subscribe to our trending updates now and become an active participant in shaping your own future. Together, let's explore the world of trending topics and uncover the insights that will empower us to make informed decisions and take meaningful action.